the hottest inflation since the 80s, triggers calls for immediate Fed action, sending stocks lower and short-end rates vertical. Geopolitical chess playing from the US and Russia ignites war fears, and commodity markets respond with wild swings. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 15th of February, and let's take a look at these markets. So last week, highly anticipated US inflation print beat expectations, came in at around 7.5% year on year, and that was the highest reading since the early 80s. Now, the most worrying parts, rather than sort of the headline, were some of, if you look at some of the details, were the median inflation. So showing that the broad-based inflation was rising, right? So rather than just looking at the things that have increased by the most, like energy or whatever, if you look at what all of the different components and you then take the median and see how that is, that gives you a slightly better idea of what's going on, right? And looking at that, if I share this screen here, courtesy of my good friend Darius at 42 Macro, the chart on the right-hand top is showing median inflation, right? And I've circled there. He's looking at the annualized percentage change, and this is for the Cleveland median CPI, and you can see it's accelerating, right? So quite a sharp increase there, right, on a 7 handle. So that's a bit worrying. And then you look at the chart below that, and that's called the sticky CPI. So the sticky CPI is also going up quite dramatically and is like at levels not seen since 1991. Okay, and sticky CPI is again filtering out the components to components that are generally slower moving and a bit less volatile and more sticky. And when you see that growing at a rate like that, these are the things that are spooking the Fed a bit, basically, right? Obviously, on the back of that, obviously the data was bad enough, but then you had Bullard, President Bullard, come out and basically say he thought it warranted 100 basis points of hikes by July. And that really spooked the market. And we were even talking about potentially a pre-March meeting emergency hike might be necessary to restore the credibility of the Fed. And the market just went berserk, right? So you can see on the bottom chart, bottom left chart now, you've got there the kind of probabilities of the different moves in rates. And this is a Fed tracker tool, right, which is available. I can share the link with you if you want on the Telegram group. But basically, this shows you that before all of this last week, before all the data, you had about 80% probability of 85% probability of a 25 basis point hike in March. And you had a pretty low probability of a 50 bip, right? Like not even 5%, let's say. And that has repriced dramatically. So now we're looking at around 60% probability of a 50 bip hike in March. And yeah, so that's how that curve is repriced, basically, right? So pretty dramatic. Basically, people saying the Fed's miles behind the curve, as we've been talking about for a while. And the only way they're going to get any hope of getting on top of this is to do a 50 bit cut out straight out the gate in March, right? So that's certainly what the market is pricing in. Now, for those of you who follow the Fed guy, Joseph Wang, he was saying, 2-3 weeks ago when he had an interview with Jack Farley about, the Fed doesn't like to shock markets, right? So yeah, an emergency rate hike would be pretty dramatic, but now they've bought themselves a hell of a lot of optionality, right? By Bullard saying what he's saying, and then some of the other Fed members walking back, the aggression of his comments, they've just bought a ton of optionality now in the fact that the market is almost 50-50 at 25 bips or 50 bips, right? So they can do what they want, basically, right? By making those statements, they've bought optionality so they can do what they want without shocking markets too badly, basically, right? So they've kind of achieved their goal there in that rhetoric that they've been putting out. Yeah. Now the other data point, most important data point to note last week was consumer confidence, right, which we had flagged was coming out on Friday, and we kind of said that was likely to not be a good print, and it was, you know, pretty low. You can see here Michigan confidence kind of at rock bottom levels, you know, consistent with 2008 financial crisis type thing, and that doesn't bode well, right? When you're seeing consumer confidence, and it's due to, you know, inflation concerns generally, right? That's driving. If you look at the chart on the right, that shows you inflation expectations for the next year, and then 5 to 10 years. You know, 5 to 10 years is a slow moving number, but it is still moving up. But, you know, for the next year, inflation expectations are just going through the roof. Okay, and these sort of confidence levels are levels we haven't seen since 2008 crisis. So with the confidence this low, with real incomes falling, as we said in previous calls, with inventories of goods rising, and no stimulus in sight, obviously, growth going forward is going to struggle. So you've got to think all these things are going to spell a bit of a downturn in growth within coming quarters, basically, right? And that's what we've been flagging, and we definitely still think that, right? Now, obviously, geopolitics has been the thing in focus for the last few days since Friday. And Russia, Ukraine, you know, the tensions there have been really dominating price action. US came out on Friday saying that they expected escalation this week, imminent invasion, basically, based on their intelligence. Russia denied it, said they didn't have any plans to attack. Putin and Biden spoke on Saturday. Who knows how productive that was. German Chancellor speaking to Putin today. But the base case for most people remains that we're not going to have a war, right? And literally overnight, or sort of this morning, we heard Russia saying that they're withdrawing troops, going back to their bases and things like that. They're actually even putting out video footage of tanks moving and things like that, right? So they're trying to convince people that they are dialing it down. There was an interesting article I read basically saying this is all like a, you know, political kind of game from Putin to expose NATO's impotence, right? And the fact that they just can't react in any sort of cohesive manner, right? And so yeah, I'll share that in the report for anyone who wants to read it. The fact that no one expects an escalation, that was the concern, right? So clearly the base case is not that we're going to go to war, but you know, this is something Jim Bianco mentioned, right? When everyone you survey who's managing money is saying there's no way that's going to happen, right? Putin doesn't want a war. That's when the tail risk is actually bigger, because no one expects that to happen. So if it was to happen, you'd get a bigger sort of market move, right? So that was the worry. And that's why the VIX over the weekend, after the weekend, the VIX really started moving, right? We saw VIX spike above 30 as people were trying to hedge that low probability tail event, right? In case it happened. Obviously, the vol's come back down since the headlines we've heard on sort of troops kind of moving back. And you see the vol, you know, quite quick to come down. That gravity that the VIX has, you know, it can reverse just as quickly as it goes up, right? And we are starting to see that. Now, if we have a look at some of the other charts, so on the support side, right? So we obviously rolled over. We kind of had this false break of that downtrend. We then rolled over on the Bullard comments and then the Russia stuff. And we started to attack this level here around 43.35. That was my first key support level on S&P. Had that been broken, we're looking at potentially 42.30 again, which was that low that we kind of made last time. I'd be looking at that. And the idea was, if we were retesting those lows, I'll be looking for bullish divergence. So I'll be looking for momentum indicator to not be making new lows as we approach those levels of support, basically, right? So, you know, looks like we're bouncing obviously on these headlines. Remains to be seen whether we're done with this kind of Russia-Ukraine episode for now. Wouldn't be surprised if it kind of lasts a bit longer. But with these type of things, you know, what happens is the market digests it and gets more comfortable with it. So then the next headline to drop often has less and less impact, basically, right? So, yeah, that's something to keep in mind. So anyway, those are the levels that I was keeping an eye on in terms of where you could potentially pick up if you're trying to add risk. Now, we do have OPEX, obviously, this week. So, you know, historically, that has led to a bit of weakness in markets. So we may still get some more weakness, and we may test these support levels even without the Russia stuff escalating further. So, you know, just kind of keep an eye out on those key levels, right? If we have a look at the VIX, it got as high as sort of 32 yesterday. It's already back to 26. This thing doesn't hang about, basically, right? So VIX, and, you know, it didn't manage to spike as high as levels that we saw previously. So that's encouraging, okay? And I kind of put out a tweet yesterday talking about VIX being elevated at 32 could easily pull back hard on de-escalation. That's going to fuel this Vanna rally that we get when vol compresses. All the people who are short puts have to cover delta against them. We see the S&P fly higher, basically, and we're seeing that now. Yeah. VIX expiry on Wednesday is also a factor for me. Like I started chipping out a little bit of March VIX yesterday at 29. Very small size. Obviously, I don't want to sell a load of VIX with a potential war looming, right? It's just not, it doesn't make a lot of sense, right? But just having a little nibble in a sensible size there. Now, the reason I use March was two reasons, right? One is that it's going to become the front month contract on Wednesday when February expires. But also selling March, you're selling a different beast. You're selling a different animal to February, basically, right? February VIX, and we're going to put out a video about what is the VIX exactly to explain this in more detail. But when you're selling February VIX and it's approaching expiry, that February VIX contract will behave very much like March vol, right? Whatever March vol does on the S&P is what that VIX is going to do, right? And that can be quite violent, right? Especially if we're heading into a potential war. Now, if you look at what the March contract represents, the March VIX contract represents the March-April forward volatility, right? Which is not the same as just a straightforward March or April vol, okay? Those are more sensitive. The forward vol is basically what the market thinks vol will be in March for the 1 month volatility maturity, basically, right? So if you think this all blows over the next few weeks, then arguably that March contract, which represents forward volatility, which is volatility in a future window of time, that arguably doesn't need to spike as much. And therefore, that kind of takes the sting out of the vol spike a little bit, right, in that contract. Now, as that contract gets closer to its maturity date, then it's going to become more volatile. But right now, the March VIX contract is a lot less volatile than the February VIX contract. So if you're going to fade vol and you want to short something, it's a hell of a lot safer to short March than it is to short February, basically, right? So that was the rationale behind that, okay? Looking at commodities. So obviously the price action in commodities has been completely about Russia and Ukraine recently, right? And this was a nice chart put out by Saxo Bank, which kind of showed you the moves from Thursday across various commodities. So you can see here, you know, what the impact was on various commodities, right? And you saw, you know, you had a safe haven bid, obviously, for the likes of gold, right? Silver, not so much, but clearly gold caught a bit of a bid there. You then have the supply shock risk of, you know, commodities that are supplied by Russia, right? So, you know, the chart here on the right is from JP Morgan saying which, you know, Russia is the major supplier of which key raw materials. Actually, palladium's a biggest one by the looks of it. But these are the key commodities that matter in terms of Russian supply. And then you saw, you know, the likes of wheat and oil and nat gas, particularly in Europe, you know, they were really spiking quite hard on that Russia story. Yeah. And then finally, the growth linked commodities, so like copper or whatever, they were coming lower, right? Because obviously if this risk is going to be a negative on growth or whatever, then those high beta industrial base metals were going to come off. And so you saw a bit of a pullback in copper on that, basically, right? So I thought that's quite an interesting chart there. Now, all right, so this chart on gold, obviously we're talking about this massive triangle that gold was carving out, and when it broke, it was probably going to have a move. It obviously got the catalyst for the break on the Russia headlines. And, you know, we've been saying that the gold vol was pretty cheap. We've seen a corresponding spike now in that vol, obviously, as we broke into the upside. Now, we're already pulling back a bit towards this kind of 1850 area, which now needs to act as support to keep this breakout alive. It'll be interesting to see if it can manage it, given that the motivation, the reason for the breakout was this Russia story. If the Russia story fades, we're so used to seeing head fakes in gold now, it wouldn't be a surprise to just get it straight back into the range. So if I'm honest, that's probably my base case. But given the vol was quite cheap, the calls look quite cheap, I figured it made sense to have a few on the book. So I am long some 1900s to end of March expiry, just in case. Because if this thing does get some legs, I mean, a move to 1950, 2000 is pretty doable. Now that it's had a catalyst for the breakout, will it suck more people into the trade? Remains to be seen. Yeah. If you look at the gold spec positioning, it's still pretty light. So that gives you some kind of comfort if you're a gold bull that this has still got a lot of room to re-rate and people to put spec longs on. But you need to really probably be above those key levels at 1850 for at least a week or two to make people think that the breakout is real. And then that might bring some buyers in, basically, right? So that's kind of how I'm looking at it on gold right now. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.